It's a mixed start to the European markets and largely on the negative side if you look at it. Let's pull up the key indices for you. You've got the CAC, which is very quiet in the session, as is the DAX. The FTSE, though, somewhat finding its feet as we speak. Remember, it was expected to be a bit of a mixed start given that the Eurozone finance ministers are meeting in Brussels today to flesh out plans to reinforce the single currency, which has been under pressure. Jerry Salaya, Chief Strategist at Redtower Asset Management, now joins in on the show to throw more light on the European markets. Jerry, thanks very much for joining in. If you could just highlight what are your expectations from the meeting later on today?
Yeah, we don't expect a lot of concrete results from the meeting. I think basically you've got a couple of contingent factors here. One is Greece is widely expected to go and try to get their terms changed and to ameliorate some of the risks, basically because there's no way they can meet the targets for their loans. I think most people are expecting what the IMF, Lagarde said last week, which is basically there's no mood for renegotiation, to pretty much underline what the EU finance ministers may tell Greece, which is, look, do the best you can, but we're not really going to renegotiate your entire bailout conditions at this time. And then the big focus will be on Spain, where Spain basically asked for money, 100 billion euros, and everybody said, okay, no problem, you'll get it. But they still haven't quite laid out the terms yet of how they're going to get it and how the money's going to come, where the money's going to come from, and what the conditions are really going to be. The key headlines here have all focused on the fact that they're not going to be as onerous as the conditions that were put upon Greece and Portugal and Ireland, which everybody said, okay, that's nice. But we still need some details. And I think investors are basically pushing Spanish 10-year yields back up towards 7%. Because there is a lack of details on exactly how this is going to work and what's going to happen. And we, again, don't really expect a lot out of the European politicians at this juncture because they've disappointed so often in the past. And that's basically going to continue to knock down sentiment. And that's why we're looking for overall shares to drift lower and bond yields to go higher in Spain and Italy.
Sure.
Okay, Jerry, just wondering, what's the call really, not just for the near term, but for the slightly medium term, because it's been, 4 or 5 straight weeks of gain for the European indices. Is there a sense that there could be some bit of profit booking or otherwise that could emerge, or generally the easing by various countries or the various central banks would lead you to believe that there could be some downside support for the markets in general?
That's a very good question. I think we saw that sharp rally from the early June lows, let's say the DAX, for instance. But the reaction after last week's ECB rate cut would be very puzzling for officials, where you saw some profit-taking come into the major indices in Europe. We're looking for that profit-taking to turn into basically a move back down towards the June lows and then back towards last year's November, summer lows, depending on the index. So we're pretty bearish on equities. Basically, we're taking the view that central banks have thrown monetary stimulus into the Eurozone equation since last November, December, and they've cut rates. And yet, you know what, they haven't really solved anything because Spanish yields are still around 7% and they're going to get higher. So we're looking for the optimism that has helped support stock prices to basically erode. So, for instance, taking a look at the DAX, it's up 8% on the year, I think. We're looking for it to basically be negative this year, and to end the year probably around somewhere between 5,500 down towards 5,000. So pretty soft is our outlook still.
And Jerry, a quick view on the euro against the dollar. You have Standard Chartered, which expects it to touch 1.18 by the end of Q1.
Yes, I think that's kind of a medium-term outlook for them. And basically, yeah, we'd agree broadly that the euro-dollar is going to remain under pressure. And we're looking for, attempts to try to break below 120, 118.76, which was that low from 2010 when Greece first revealed its problems. And, as things get worse, we would expect the euro-dollar to basically drift towards 116 and 112 over the next few quarters. But yes, we broadly agree with that. The euro-dollar should probably remain under pressure.
Jerry Salaya, thanks very much for taking the time out and joining in. It's a mixed start to the European markets, but largely on the negative side.